Brightline was supposed to be different, a private company powered by private money daring to prove that America could finally build modern passenger rail without subsidies or Amtrak's baggage. It promised to change how we travel: fewer cars, fewer planes, more trains. But the story has taken a sharp turn. Brightline isn't fighting bad press or tragic accidents. Instead, it's facing something tougher: a financial reality that doesn't match the dream investors bought into. In today's episode of Great Trainspeed, we dive into the challenges Brightline faces and ask, can this bold experiment survive? For years, Brightline was widely treated as an outlier in American rail. Unlike traditional public sector projects, it moved quickly. Stations were built in urban cores rather than suburban fringes. Trains were marketed like airlines, complete with premium seating, assigned reservations, and a focus on customer experience rather than mere mobility. The Miami-Orlando extension in particular was heralded as a turning point, demonstrating that private rail could link major metropolitan areas over meaningful distances. The underlying logic was straightforward. Florida's highways are chronically congested. Its airports are crowded, particularly during peak tourism seasons. The distances between cities such as Miami, Fort Lauderdale, West Palm Beach, Orlando, and further on Tampa are long enough to make driving tedious, but short enough to place rail in direct competition with short-haul flights. If private intercity rail could work anywhere in the U.S., Florida seemed the most plausible candidate. Early ridership figures appeared to validate this optimism. Media coverage emphasized growth, expansion, and the broader implications for American infrastructure. Brightline was not merely operating trains, it was reshaping expectations. However, while the visible elements of the system, stations, trains, branding, were expanding rapidly, the financial underpinnings of the project were becoming increasingly strained. In the next section, we'll examine the challenges Brightline is dealing with and why they're becoming harder to ignore. And if you find this kind of analysis useful, consider subscribing so you won't miss future updates on major rail developments. At the core of Brightline's challenges lies a simple but unforgiving fact: ridership growth has not matched projections. According to assessments by credit rating agencies, revenue performance in the second half of the previous year fell short of expectations, prompting a downgrade of Brightline's senior debt deeper into speculative, or junk, territory. They now expect ticket revenues of approximately $174 million for 2025 based on performance through November, representing a mere 14% growth, a significant decline from our initial forecast. In our last review in August 2025, we forecast 2025 total ticket revenue of $205 million and $176 million for our base and downside cases, respectively. This assessment is critical not because it suggests that the service lacks demand, but because it reveals the limits of that demand under current pricing and behavioral conditions. Even though Brightline's trains are not empty. On the contrary, many services are well patronized, particularly during peak travel periods. The problem is not the absence of riders, but the difficulty of converting sufficient numbers of Floridians away from cars. Even in a state with some of the worst traffic congestion in the country, automobile dependence remains deeply entrenched. Driving offers door-to-door convenience, flexibility, and often lower perceived costs, especially when fuel prices are moderate and parking is readily available. To overcome these barriers, Brightline relied heavily on discounted fares during its growth phase. Promotional pricing, bundled offers, and introductory deals succeeded in attracting riders and building awareness. However, these discounts also established a price ceiling that has proven difficult to break. Once customers anchor their expectations to low fares, attempts to raise prices risk suppressing demand. This creates a structural imbalance. Brightline operates a premium service with high fixed costs, including staffing, maintenance, energy consumption, and station operations. Yet its revenue growth is constrained by fare sensitivity. The result is a system caught between premium costs and a discount-level pricing dynamic that undermines long-term financial sustainability. And if you think that's all Brightline is dealing with, hold on, there's more. And this next problem only makes the situation even tougher for the company. The second and more consequential issue is Brightline's debt burden. Across its corporate structure and affiliated entities, Brightline carries approximately $5.5 billion in total obligations. This figure includes corporate debt as well as municipal bonds tied to commuter rail projects connected to the core line. Some of this debt carries interest rates approaching 11%, reflecting both the risk profile of the project and the broader environment for private infrastructure financing. Debt of this magnitude is not inherently problematic for capital-intensive infrastructure. Rail systems, by their nature, require substantial upfront investment. The challenge arises when revenue growth fails to keep pace with debt service obligations. This imbalance became increasingly apparent as Brightline approached a January interest payment, prompting creditors to engage legal advisors and explore potential restructuring or refinancing scenarios. Moves like this are not made casually. When hedge funds that hold high-interest bonds and insurers that back major loans start hiring lawyers and working together, it's a clear sign they are worried about cash flow and protecting themselves if things get worse. One bond insurer, Assured Guarantee, which guarantees $1.1 billion of a $2.2 billion senior debt package, has brought in the law firm Milbank. This is not what confident hands-off investors do. These are defensive steps taken when uncertainty rises and investors want to protect their money. Compounding these pressures, Brightline disclosed in investor materials that it is seeking an additional $100 million in debt financing. Importantly, this capital is not earmarked for expansion or service enhancement. Instead, it is intended to provide liquidity for ongoing operations and to address potential legal liabilities. One of the clearest signs of financial pressure came from a property sale that didn't seem very important at first. Brightline sold its 7-story parking garage next to the Fort Lauderdale station for $18.5 million, even though it had bought the building in 2023 for $21 million. After selling it, Brightline agreed to lease the garage back for 25 years so passengers could continue using it. Deals like this usually happen when a company needs cash urgently. It signals that Brightline is willing, or forced, to turn long-term assets into short-term cash to deal with current financial stress. Once this threshold is crossed, negotiating dynamics change. Future expansion proposals are scrutinized more heavily. The company's bargaining position weakens, and the emphasis shifts from growth narratives to stability assurances. Additionally, Brightline's financial challenges are being intensified by legal risks. The company is facing several lawsuits, including disputes over rail corridor access and commuter rail planning, as well as a claim from a former conductor who alleges psychological trauma after witnessing fatal train accidents. While the potential cost of these cases has been estimated at around $60 million, there is no legal confirmation of this figure. Even so, these unresolved legal matters add another layer of risk to an already strained financial situation. For investors, uncertainty is often more troubling than known expenses. Brightline has begun setting aside cash in case it needs to pay legal settlements. While this is a cautious move, it also means less money is available to improve daily operations. Cash held for legal risks cannot be used to run more trains, improve reliability, or upgrade the passenger experiences that could help grow ridership. Ongoing legal uncertainty also makes long-term planning harder. When major liabilities are unresolved, companies tend to delay big decisions, creating a cycle of caution that slows growth even further. Credit rating agencies now say that if current trends do not improve, Brightline faces a higher risk of default by 2027. This does not mean the system is about to shut down. Trains will not suddenly stop running, and stations will not close overnight. Instead, it marks a turning point. We think that switching riders from alternate modes, automotive in particular, is more challenging than originally forecast. Fares that have been drastically discounted to encourage new riders have proven particularly sticky, and we believe that projected growth in ticket revenue into 2026 is unlikely to materialize. Looking ahead, we now project lower growth in ticket revenue of 15% in our base case in 2026, leading us to expect a higher probability of default by January 2027 for the railroad, as liquidity available would be insufficient to meet debt service obligations. Do you think these challenges could slow or even stop Brightline from becoming a key part of America's public transportation network? Share your thoughts in the comments below. We'd love to hear what you think. So what actually went wrong? Brightline's challenges do not stem from a failure of rail as a mode of transportation. Rather, they reflect the limits of three key assumptions. First, the project overestimated the speed at which Americans would abandon cars, even in a market as congested as Florida. Behavioral change in transportation is gradual, influenced by culture, convenience, and habit as much as by cost or speed. Second, the project underestimated the cumulative expense of private rail operations. Discounts, staffing, maintenance, energy, and debt service interact in complex ways, magnifying costs beyond initial projections. Third, Brightline expanded infrastructure faster than its revenue base could sustainably support. By building first and relying on future demand growth to close the gap, the project accepted a level of risk that is difficult to manage without public backstops. These miscalculations do not negate Brightline's achievements, but they do contextualize its current predicament. Imagine boarding a train in New York and stepping off in Los Angeles less than 72 hours later. That was the dream Ameristar Rail unveiled in mid-2025, sparking excitement across the country. Rail fans debated routes, travelers envisioned convenience, and the media hailed it as a breakthrough. But just months later, the dream collapsed. Amtrak swiftly rejected the proposal, leaving many to ask, why? The truth is more complex than headlines suggest. The transcontinental chief wasn't destroyed. It stumbled at its first test. Could Amtrak's choice be the correct one in this situation? Today on Great Trainspeed, we'll explore why cooperation proved so difficult and what it means for rail's future. Ameristar Rail's proposal sounded straightforward at first glance. No new tracks, no new federal legislation, mostly private funding. These claims caught the media's attention and drew optimism from rail enthusiasts and potential investors. The company presented a grand vision of a transcontinental rail system, claiming that the project would use existing rail lines, thus minimizing the need for new infrastructure and reducing costs. However, one crucial line in the proposal held the key to the failure. Subject to operating agreements with host railroads. This single sentence reveals the fundamental flaw of the entire proposal. Most of the rail routes required for the transcontinental chief's operation are controlled by freight railroads, which for decades have been openly resistant to the introduction of new long-distance passenger services. These freight companies hold considerable sway over the rail network as they control access to crucial tracks. Their resistance to passenger rail services is rooted in concerns over capacity, efficiency, and profitability. Ameristar Rail never secured agreements with these railroads, nor did it engage in serious negotiations to obtain necessary access or resolve conflicts related to dispatching, track scheduling, and train slot allocation. The proposal effectively asked Amtrak to make the uncooperative freight companies work with them, without addressing the legal and operational complexities involved. This is a way to confront the challenges Amtrak faces and create opportunities for them to succeed. Ameristar Rail CEO Scott Spencer told USA Today, "We're hopeful that all the parties that are involved, including the host railroads, recognize what a great opportunity this is for our nation. Even though simply drawing a long line on a map and hoping it would work out is not a well-thought-out plan, it's a wish." To secure such a project, Ameristar Rail would have had to address the complexities of coordinating with freight railroads, a task they never seriously undertook. One of the major issues with Ameristar Rail's proposal was the lack of a solid business case. While the company boasted that the project would be privately funded and would not require new federal legislation, it quickly became clear that the financial details were murky at best. Amtrak's review of the plan found that it lacked a fundamental business case to support its lofty proposal. This wasn't a matter of having incomplete financial data. It was a proposal that fundamentally failed to address the financial realities of such an ambitious project. First, Ameristar Rail offered no clear projections for ridership or detailed revenue models. While they emphasized that no new tracks would be necessary, the revenue needed to sustain a transcontinental train service would still be substantial. Passenger services, especially on long-haul routes, often struggle to generate enough revenue to cover operational costs, and Ameristar Rail did not provide any convincing evidence that this model would be different. The combination of freight and passenger services raised further questions. Would the freight component generate sufficient revenue to offset the costs of the passenger service? How would the company balance the operational needs of both? Ameristar Rail also failed to provide specifics about investment commitments. A project of this magnitude requires a solid financial plan with confirmed backing from investors or stakeholders. The company's vague reference to private funding did little to reassure Amtrak, especially given the scale of the project and the lack of any concrete financial backing. Without clear and detailed financial planning, the project could not be considered viable. Additionally, public-private partnerships were not part of the proposal. Large-scale rail initiatives in the U.S. often require collaboration with federal or state agencies to address funding gaps, especially in areas like infrastructure upgrades. Ameristar Rail's refusal to discuss this aspect of the project further diminished its credibility. The idea that such a large, complex operation could be entirely funded by private investment without any public sector involvement was unrealistic and raised doubts about the project's long-term sustainability. Finally, the absence of financial risk assessments was a significant red flag. A project like this involves substantial risks: operational, financial, and regulatory. Ameristar Rail's plan to transport both passengers and freight on the same route would have introduced significant operational challenges, including the possibility of delays, mechanical issues, and scheduling conflicts with freight trains. These risks, which could disrupt the entire service, were not adequately addressed in the proposal, further weakening its business case. This shift from engineering to press releases was a telltale sign that the Transcontinental Chief project was more about creating headlines than creating a feasible plan. For a project like this to be taken seriously, it would need to be based on solid financial data and a clear, achievable business case, both of which Ameristar Rail failed to provide. One of the most audacious claims made by Ameristar Rail was the 72-hour travel time from New York to Los Angeles, which served as the centerpiece of their marketing campaign. It was designed to capture the public's attention and spark excitement. However, when we take a closer look at the logistics, it becomes clear that this claim was far from realistic. Ameristar Rail's proposed route, with its multiple intermediate stops, would already add at least 16 hours of dwell time. This doesn't even take into account the unavoidable delays that would occur, such as crew changes, station congestion, freight train interference, weather-related disruptions, and mechanical issues. To put this into perspective, even the fastest, long-distance freight trains today take 2 to 3 days to travel between Los Angeles and Chicago. With the additional stops, mixed-use tracks shared with freight and passenger services, and the limitations of current infrastructure, there was no feasible way for this train to meet the 72-hour promise. What began as an ambitious target soon revealed itself to be a mere fantasy. A transcontinental train operating on tracks shared with freight, passenger, and auto transport simply could not achieve a 72-hour transit time. The logistics alone made it an impossibility. To further bolster their proposal, Ameristar Rail pointed to Amtrak's auto train as proof that their hybrid model could work. The auto train operates successfully between Virginia and Florida, but it does so with a very specific set of conditions. 1 route, 2 terminals. No intermediate stops. A well-established market for auto transport between the Northeast and Florida. Ameristar Rail's proposal was vastly more complex. They sought to replicate the auto train model, but across thousands of miles with multiple stops, varying routes, and the additional burden of mixed freight transport. This scale-up would have required specialized infrastructure, additional terminals, and increased operating time for vehicle loading and unloading. In reality, there is very little demand for auto transport on routes like New York to Los Angeles, especially on the scale proposed. The auto train serves a niche market, but there is no analogous demand for cross-country car transport between cities like Chicago and Albuquerque, which are separated by thousands of miles. Trying to scale the auto train concept across the country on mixed freight tracks was a misapplication of the model. Ameristar Rail's proposed plan ignored the lessons learned from the auto train, such as the necessity for specialized terminals and the complexity of long-distance auto transport. The model simply wouldn't work on the proposed transcontinental scale. Do you believe media exposure can sometimes give unfeasible projects an unfair advantage? Share your opinion on how much media influence plays a role in shaping public perception. We would love to hear your thoughts in the comments below. Ameristar Rail is not alone in proposing unrealistic rail projects. Pipe dreams and overly ambitious rail plans often surface, but what made this proposal different was its media access. Ameristar Rail included a former Amtrak executive with strong connections to journalists, enabling the proposal to gain traction far more quickly than most similar projects. Stories were strategically planted with reporters who didn't have the technical expertise to evaluate the proposal's feasibility. This media exposure created a sense of false hope and misplaced anger when Amtrak inevitably rejected the plan. In reality, the transcontinental chief was no more serious than other far-fetched ideas. It was just louder. The extensive media coverage, combined with Ameristar Rail's connections, generated excitement but ultimately obscured the project's fundamental flaws. Amtrak's decision to reject the transcontinental chief proposal wasn't driven by a reluctance to embrace private investment or innovation. Rather, it was a result of careful due diligence. The primary reasons for Amtrak's rejection were clear: the lack of agreements with freight railroads, a weak business case with no solid financial backing, increased operational risks from the hybrid service model, an unrealistic timeline that ignored operational constraints, and a legal framework that placed full responsibility on Amtrak. Far from being an act of obstruction, walking away from this proposal was a pragmatic and necessary decision. Amtrak's focus has always been on delivering reliable interstate passenger service. The transcontinental chief, however, did not align with Amtrak's long-term strategy. It would have stretched their resources, increased the risk of delays, and created significant operational chaos. The real lesson here is that the transcontinental chief didn't fail because Amtrak said no. It failed because it never addressed the realities of the U.S. rail system. It overlooked the power of freight railroads, the logistical challenges inherent in rail operations, the legal constraints Amtrak faces as the sole operator of transcontinental services, and basic financial principles. This project wasn't killed, it was never viable in the first place. Ameristar Rail's vision, while ambitious, lacked the concrete planning, feasibility studies, and legal groundwork necessary to turn it into a workable reality.